Eleanor had $847,000 in her retirement account on a Tuesday in October. She knows this because she checked it that morning, the same way she had been checking it every Tuesday morning for 11 years. Tuesdays were her ritual. The number had been growing, steadily, reliably, the way everything she had been told to expect said it would grow. She had done everything right. Low-cost index fund, automatic contributions, never touched it during the downturns. Her financial advisor called her a model client. By the following March, the account held $591,000. She had not made a single decision during those 5 months. She had not changed her allocation. She had not panicked and sold. She had simply done what she was told to do, which was nothing, and watched $256,000 leave her account without her permission. Her advisor told her the market always recovers. She asked him when. He said, eventually. Eleanor is not a fictional character created to make a point. She is a pattern. She is what happens when someone follows the conventional advice exactly as given and discovers that the advice was missing something important. Not wrong, missing something. The distinction matters because what was missing was not complicated. It was just never mentioned. Here is what was never mentioned. The index fund Eleanor had been contributing to for 11 years, the one described to her as holding 500 of America's best companies, had quietly become something different from what that description suggested. As of the period before her losses, more than 30% of that fund's total value was concentrated in 7 companies. 7 out of 500. 1.4% of the companies held nearly a third of the weight. Eleanor thought she owned 500 companies in roughly equal measure. She did not. She owned a portfolio that was, in meaningful structural terms, a leveraged bet on a handful of technology companies continuing to be worth what the market had decided they were worth at an unusually optimistic moment in history. She was not diversified. She was concentrated, and nobody had shown her the difference. This is not a new story. The costume changes, the structure does not. In 1719, a Scottish financier named John Law arrived in France with a solution to the country's enormous debt problem. France was broke after decades of warfare. Law's proposal was elegant on the surface. He would create a bank, issue paper currency backed by the future profits of French territories in the Americas, and use the resulting capital to absorb the government's debts. The French government, desperate and without better options, agreed. Law created the Mississippi Company, which held the rights to develop Louisiana. He issued shares. The shares began to rise. People converted their property and jewelry into shares because the price was moving, and moving meant something was happening. From 500 livres, the shares climbed to 2,000, then 8,000, then 18,000. People camped outside Law's offices waiting for access to the next offering. Men and women who had never thought about financial instruments were suddenly speculators. The Louisiana Territory was swampland. There was no gold. There was no profitable trade. There was land that generated nothing, and a share price that reflected not the land's value, but investors' belief in each other's continued willingness to pay higher prices for the same nothing. When, in 1720, investors began converting shares back to gold and discovered the gold was not there, the price moved the other direction, with the same velocity it had moved upward, from 18,000 to 500 in months, then to zero. France banned paper money for decades. Law died in Venice 9 years later with nothing. Here is what the story of John Law is actually about. Not fraud, though there was fraud. Not stupidity, though there was credulity. It is about the gap between what something is called and what it actually is. Law called his paper instruments wealth. They were claims on wealth that did not exist. The instrument and the description of the instrument had separated from each other, and most people never noticed until the separation became impossible to ignore. Comment below what percentage of your retirement or investment account is currently in a standard S&P 500 index fund. Not what you think the number is. Go look. I will wait. The Nifty 50 happened 50 years after John Law's death and 3 years after Eleanor was born, though she has never heard of it. In the early 1970s, Institutional investors in the United States developed a consensus around 50 stocks that were considered so fundamentally dominant, so essential to the functioning of American economic life, that valuation did not need to be a consideration. You bought them and held them indefinitely. Polaroid, Xerox, Kodak, Avon, Sears. These were not speculative companies. These were the companies that made the objects sitting in American homes. Cameras, copiers, film, cosmetics, retail. The logic was that companies this essential to daily life could only grow. Slower years and faster years, but always growth. This logic drove their price-to-earnings ratios to 50, 60, 80 times earnings. The prices reflected not current value, but the certainty of future value. Then, 1973. An oil crisis, inflation, a recession that made growth stocks stop growing. The certainty evaporated. Polaroid lost 91% of its value from peak to trough. Avon lost 86%. Xerox lost 71%. These were the safest companies in America. If you had purchased them at their peak in 1972, you spent 25 years waiting to break even on some of them, not accounting for inflation. A quarter century for the safest investments available. The mechanism was identical to John Law. Institutions decided a specific group of assets was so obviously good that valuation stopped mattering. Their purchasing drove prices higher. The higher prices became evidence of quality, which attracted more purchasing. When economic conditions changed and growth stopped being certain, the assets had the furthest to fall, because they had been priced for a certainty that no longer existed. Who made money? Executives who sold at peak valuations, investment banks who collected underwriting fees, early investors who entered at reasonable prices and exited before conditions changed. Who lost? The people who were told these were the safe investments, the pension funds, the retirees, the model clients. Now look at the current moment. NVIDIA was worth approximately $300 billion in early 2023. By early 2026, the company had crossed $3 trillion, a tenfold increase in under 3 years. Their revenue grew meaningfully during this period. Their technology is genuinely significant. The growth is real. But their revenue did not grow 10 times. Their earnings did not grow 10 times. What grew 10 times was the multiple that investors were willing to pay for each dollar of earnings. The price moved faster than the underlying business. This is not unusual in the history of transformative technologies. It is also not unusual in the history of assets that subsequently lost half their value. NVIDIA is not the point. The point is that your index fund is now meaningfully dependent on NVIDIA's current valuation being correct or continuing to rise. If NVIDIA drops 50%, which is not a scenario without historical precedent for any high-flying technology company in any era, that single stock removes approximately 4 to 5% from the S&P 500 total. Include similar movements in the other 6 largest holdings, and you are looking at losses of 20 to 30% in the overall index, even if the remaining 493 companies perform perfectly well. This is what Eleanor owned without knowing it. Not 500 companies, a concentrated position in a handful of companies priced at valuations that assume continued and uninterrupted dominance. Comment the word concentrated below if you looked up your top 10 holdings just now and the total percentage was larger than you expected. No explanation needed, just the word. The mechanism that hides this from you is not complicated once you see it. It is called market capitalization weighting. When you buy an S&P 500 index fund, the fund does not purchase equal amounts of each of the 500 companies. It purchases each company in proportion to its total market value. Companies that are worth more get more of your money automatically, which means that as a company's stock price rises, it becomes a larger and larger share of your fund without you doing anything. The stocks that have already gone up the most receive the most new money every time you make a contribution. This is the opposite of the behavior that produces the best outcomes in other markets. You would not buy more of a house as its price rose and less of it as its price fell. You would not automatically increase your allocation to the most expensive items in a grocery store and decrease your allocation to the cheaper ones. But that is precisely the structure of what the index fund does automatically every day with your money. The people who designed this structure had reasons for it that made sense in certain contexts. The issue is not that market cap weighting is irrational. The issue is that when it produces extreme concentration, the risk profile of the instrument no longer matches the description of the instrument. You are told you own a broad, diversified basket of American companies. You own a concentrated position in the most expensive tier of American companies at a historical peak in their relative valuation. Yale University's endowment, which is managed specifically to generate returns across different economic environments without catastrophic losses, holds less than 10% of its assets in U.S. equities. 10%. An institution with more information and more sophisticated analysis than any individual retail investor has allocated 90% of its capital to things other than the S&P 500. This is not coincidence. If Eleanor had known this 12 months before her losses, here is what she could have done differently. Not market timing, not speculation, structure. She could have examined her actual holdings and identified the concentration. She could have moved a portion of her allocation into equal weight index funds, where all 500 companies received the same percentage regardless of size. She could have added international developed markets, which were trading at historically low valuations relative to U.S. equities, providing exposure to growth without the concentration premium. She could have added small and mid-cap value stocks, which had underperformed large-cap growth for a decade and historically produced superior returns over 20-year periods, precisely because they were not priced for perfection. She could have built 12 months of living expenses in cash outside the market, not because cash is a good long-term investment, but because cash means you do not have to sell equities when equities are down. The people who bought stocks at the bottom of the 2008 crash were not genius investors who predicted the timing. They were people who had liquidity. The people who sold at the bottom were not panicking irrationally. They were people who had no other option. The difference between making money in a crash and losing money in a crash is often not intelligence. It is whether you built the buffer before the crash. None of this would have guaranteed Eleanor protection. Markets are not systems where preparation produces guaranteed outcomes. What preparation produces is the ability to stay in the game when staying in the game is the right move, and the ability to make decisions from a position of choice rather than desperation. Desperate financial decisions are almost always expensive. You sell when you should hold and buy back in when prices have recovered. In 1989, the Japanese Nikkei index reached 38,915 points. Japanese companies were purchasing American real estate. Analysts described the Japanese economy as structurally superior and argued that valuations that seemed extreme by historical standards were appropriate for a new kind of growth. The index traded at 60 times earnings because the growth was considered certain. The Nikkei bottomed near 7,000 in 2003. In 2026, 37 years after the peak, it has only recently returned to those levels. A Japanese investor who put money into that index at the peak and held, following exactly the advice to buy and hold forever, spent 37 years waiting to break even in nominal terms. In real terms, accounting for inflation, they never recovered. The market always recovers is a sentence about the global market over a century. It is not a sentence about any specific market in any specific period. A U.S. investor in 2026 who assumes that sentence applies to the current U.S. equity market is making a prediction about the future that 37 years of Japanese investors would recognize. This is not a prediction that the U.S. market is Japan. It is an observation that the phrase, "the market always recovers," is doing more work than it can support. Here is what actually working toward protection looks like in practice. Check your holdings. Log into whatever account holds your retirement savings tonight and look at the top 10 positions in your index fund. Add the percentages. If they exceed 25%, you are concentrated in a way that does not match the description you were given. Most major brokerages publish this information on the fund's detail page. It takes 5 minutes. Most people have never done it. Rebalance toward assets that do not move in the same direction at the same time as large-cap U.S. equities. International developed markets, which trade at historically low valuations relative to U.S. equities right now. Equal weight domestic funds, where Apple and a regional bank you have never heard of receive the same allocation. Small and mid-cap value stocks, which have underperformed large-cap growth for a decade and historically outperform over 20-year periods precisely because they are priced without the premium that certainty commands. Real assets, including real estate investment trusts that hold physical property, commodities, infrastructure. None of these are exotic instruments. They are available from every major brokerage. The point is not to find assets that will perform better. It is to find assets whose performance does not depend on the same 7 companies continuing to justify their current valuations. A portfolio that holds 30% in equal weight U.S. equities, 20% in international developed markets, 10% in emerging markets for long-term growth exposure, 15% in real assets, 15% in a mix of bonds, and 10% in cash or short-term equivalents would not outperform a concentrated S&P 500 fund if current trends continue and megacap technology doubles again. It would underperform. That underperformance is the cost of the insurance. The question is whether the insurance is worth buying given what you know about the structure of the current market and how long you have before you need the money. If you are 25 years from needing your retirement savings, you can absorb a 30% loss and a decade of recovery. If you are 8 years from needing your retirement savings, a 30% loss at the wrong time is not something you recover from within your available timeline. The correct level of concentration risk is not fixed. It depends on how much time you have to wait for eventually. Build cash. 12 months of actual living expenses in a high-yield savings account earning 4 to 5% annually. This is not an opportunity cost. It is the instrument that allows you to hold equities through a crash instead of selling them. During 2008, the investors who purchased equities at the bottom were not clairvoyant about timing. They had liquidity. The investors who sold at the bottom were not irrational. They had no other way to cover their obligations. Same event, opposite outcomes. The difference was built before the crash, not during it. Set rules that operate independently of your emotional state in the moment, because your emotional state in the moment of a significant market decline will not be reliable. If any single company exceeds 8% of your total portfolio value, sell enough to bring it back to 8%. If the price-to-earnings ratio of your primary index fund exceeds 30, move 10% of your equity allocation into bonds or cash. You are not predicting a crash. You are recognizing that expensive assets have historically produced lower subsequent returns than inexpensive assets, and you are rebalancing without needing to know when the market will recognize that fact. Eleanor's advisor told her the market always recovers. He was not lying. He was using a true sentence in a context where it was missing something. The question I am not going to answer today is the one that Eleanor asked her advisor and that he could not answer satisfactorily. If the strategy is to hold through every downturn and wait for recovery, and recovery can take 37 years in the worst historical cases, what is the actual plan for the years between the loss and the recovery, and who bears the cost of those years? Leave your answer in the comments. The financial answer and the other one. Because the financial industry has a complete answer to the first question and almost nothing to say about the second, and the second one is where most people actually live. Eleanor is still waiting to find out when eventually arrives. You still have time to ask the question before you need the answer.